Listen carefully, because what I'm about to share with you could be the difference between protecting your wealth and watching it evaporate over the next few months. We're at a critical juncture right now, and the clock is literally ticking down to the weekend market close. Here's what's happening that nobody's talking about. Gold just closed at $2,644 per ounce, and silver's sitting at 30.12s. Now, those numbers might not mean much to you on the surface, but when you understand what's happening behind the scenes, you'll realize why this weekend represents a pivotal moment. Let me paint you a picture of what's really going on. The COMEX, which is the major commodities exchange where gold and silver futures are traded, is showing something absolutely extraordinary right now. We're seeing a massive divergence between paper gold and physical gold. What does that mean? It means the price you see on your screen, that 2,644 number, is increasingly disconnected from what's happening in the real world where actual physical metal changes hands. I was looking at the data yesterday, and here's what jumped out at me. The gold to silver ratio is sitting at around 87-1 right now. Historically, that ratio has averaged closer to 60-1. But here's the kicker. When you look at the actual physical market, dealers are reporting something completely different. They're seeing premiums on silver coins and bars that are 30 to 40% above spot price. Think about that for a second. If silver is trading at $30 on paper, people are actually paying $39 to $42 to get their hands on physical metal. Why does this matter for you right now, this weekend specifically? Because we're heading into a period where the markets are going to be closed, and some very significant things are happening that could change everything when trading resumes. The Federal Reserve just made an announcement that's sending shockwaves through the precious metals community. They're signaling that interest rate cuts might be coming sooner than expected, but here's what's really interesting. They're doing this while inflation is still running hot. The official CPI number says inflation is around 3.1%, but anyone who's been to a grocery store or paid a utility bill knows that's not reflecting reality. Real inflation, when you calculate it the way it was done back in 1980, is running somewhere between 8 and 12%. Now, let me tell you a story that illustrates exactly what's happening right now. Back in 2008, right before the financial crisis really hit, there was a 2-week period in September where gold dropped from $920 to $720 per ounce. Everyone thought the gold bull market was over. The mainstream media was declaring that gold was done, that it was just a speculative bubble. But here's what was really happening. Major institutions were being forced to liquidate their gold positions to cover margin calls in other markets. It was a liquidity crisis, not a fundamental shift in gold's value. What happened next? Within 6 months, gold was back above $1,000. Within 3 years, it hit $1,900. The people who understood what was really happening, who saw that temporary dip as an opportunity rather than a disaster, they positioned themselves to capture one of the greatest wealth transfers in modern history. We're seeing echoes of that same pattern right now. Gold has pulled back from its recent highs around 2,765, and the mainstream narrative is starting to shift. You're hearing analysts say that gold's rally is over, that with the Fed potentially raising rates, there's no reason to own gold. But when you dig into what's actually happening, you see a completely different story. Central banks around the world are buying gold at a pace we haven't seen since 1967. Let me give you some specific numbers. In the third quarter of this year alone, central banks purchased 337 tons of gold. That's the highest quarterly purchase in over 55 years. China's central bank has been buying gold for 18 consecutive months. Turkey increased its gold reserves by 30 tons in just the last quarter. Poland, Singapore, India, they're all accumulating. Why are they doing this? Because they see something coming that they're not talking about publicly. They understand that the dollar's role as the world's reserve currency is being challenged in ways it hasn't been since the Bretton Woods system collapsed in 1971. Speaking of 1971, let me take you back to that moment because it's incredibly relevant to what's happening right now. On August 15, 1971, President Nixon closed the gold window. He announced that the United States would no longer convert dollars to gold at the fixed rate of $35 per ounce. At the time, gold was trading at exactly that price, $35. The mainstream economists said this was a good thing that it would give the government more flexibility to manage the economy. What happened over the next 9 years? Gold went from $35 to $850. That's a 2,329% increase. People who understood what was really happening, who saw that the removal of gold backing meant the dollar could be printed without restraint, they positioned themselves accordingly. A $10,000 investment in physical gold in 1971 would have been worth $242,900 by 1980. But here's what's even more important. It wasn't a straight lineup. There were multiple pullbacks along the way. In 1974, gold dropped from $195 to $103. People panicked and sold. Those who understood the bigger picture bought more. In 1976, there was another significant dip. Same thing happened. The people who stayed focused on the fundamental drivers, not the short-term price movements. They're the ones who captured the full move. We're in a similar setup right now, but the stakes are actually much higher. Back in 1971, the U.S. national debt was $398 billion. Today, it's $36 trillion. Back then, the Fed's balance sheet was $80 billion. Today, it's $7.7 trillion. The scale of the monetary expansion we've seen over the past 15 years makes the 1970s look like a practice run. And here's something that should really get your attention. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, are actively working on creating an alternative to the dollar-based system. They're not just talking about it anymore. They're implementing it. Russia and China are settling trade in their own currencies. Saudi Arabia is now accepting yuan for oil sales. The United Arab Emirates just announced they're open to trading oil in currencies other than dollars. What does this mean for you? It means the dollar's purchasing power is under assault from multiple directions simultaneously. And when the dollar weakens, gold and silver don't just go up, they explode higher. Now, let me show you what's happening in the physical market right now, because this is where things get really interesting. The U.S. Mint reported that in November they sold 133,000 ounces of gold eagles. That's a 47% increase from the previous month. Silver eagle sales hit 4.2 million ounces. Dealers are reporting wait times of 3 to 4 weeks for certain products. Some popular silver rounds and bars are completely sold out. This is happening while the paper price is consolidating. Do you see the disconnect? The paper market, where big banks and hedge funds trade contracts, is saying one thing. The physical market, where real people and institutions are taking delivery of actual metal, is saying something completely different. I want to share something with you that most people don't know about. There's a mechanism in the gold market called backwardation. Normally, gold for future delivery trades at a premium to gold for immediate delivery. That's because there's a cost to store and insure gold over time. But occasionally, the market goes into backwardation, where immediate delivery gold trades at a premium to future delivery. This is a sign of extreme stress in the physical market. We saw backwardation in 2008, right before gold's massive rally. We saw it again in 2013 before gold bottomed and began its current bull market. And we're starting to see signs of it again right now. The premium for immediate delivery is creeping higher. This tells us that people who actually need physical gold are willing to pay more to get it now rather than wait. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without tax penalties, and it explains the specific steps you need to take. Worth checking out if that's relevant to your situation. Now back to what's happening this weekend and why timing matters so much right now. When markets close on Friday, we're heading into a period where anything can happen. Geopolitical events don't wait for markets to open. Economic crises don't check the trading calendar. And right now, we're sitting on a powder keg of potential catalysts. Let me walk you through what's lined up. The European Central Bank is meeting next week, and there's growing speculation they're going to have to cut rates more aggressively than planned. Why? Because Europe's economy is teetering on the edge of recession. Germany, which has been the economic engine of Europe, just reported its second consecutive quarter of negative growth. France is dealing with political instability. Italy's debt-to-GDP ratio is approaching 150%. When the ECB cuts rates, what happens? The euro weakens against the dollar, which puts pressure on the Fed to respond. It becomes a race to the bottom, with each central bank trying to devalue its currency to maintain export competitiveness. And in that environment, gold becomes the only currency that can't be printed. Then there's what's happening in the Middle East. I'm not going to speculate on specific events, but I will tell you this. Every major conflict in the past 50 years has been preceded by a surge in gold, buying by those who saw it coming. In the 6 months before the Gulf War in 1990, gold rallied 20%. Before the Iraq invasion in 2003, gold was up 25% in the preceding year. Before the 2008 financial crisis, gold had already doubled from its 2001 lows. The smart money doesn't wait for the crisis to hit. They position themselves before it happens. And right now, the smart money is accumulating gold and silver at a pace that suggests they see something big on the horizon. Let me give you another specific example of what I'm talking about. In 2010, John Paulson, the hedge fund manager who made billions betting against subprime mortgages, announced that he was putting a significant portion of his fund into gold. At the time, gold was trading around $200 per ounce. People thought he was crazy. Gold had already rallied from $250 to $1 in $200. Surely it was overvalued, right? Gold went to $1,900 within a year. Paulson's gold fund returned 38%, while the stock market was essentially flat. He understood something that most people missed. The monetary expansion that was being used to fix the financial crisis was going to devalue the dollar far more than anyone was admitting. We're in that same situation now, but the monetary expansion is even larger. The Fed printed more money in 2020 and 2021 than in the entire history of the United States combined. Think about that. More dollars were created in 2 years than in the previous 230 years, and people wonder why inflation is running hot and why gold is making new all-time highs. Here's something else that's happening right now that you need to understand. The commercial banks, the big players who trade gold futures on the COMEX, they've been net short gold for years. That means they've been betting on gold going down. But in the past 3 months, their short position has decreased by 40%. They're covering their shorts. They're reducing their bets against gold. Why would they do that? Because they have access to information and analysis that suggests gold is going higher, and they don't want to be caught on the wrong side of that move. When the big banks start covering their shorts, that's a signal that something significant is about to happen. Now let's talk about silver for a minute, because silver is setting up for something potentially even more explosive than gold. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. About 50% of silver demand comes from industrial uses: solar panels, electronics, medical devices, electric vehicles. The other 50% comes from investment and jewelry demand. Here's what's happening on the industrial side. The solar industry alone is projected to use 20% more silver in 2024 than it did in 2023. Electric vehicle production is ramping up, and each EV uses about twice as much silver as a traditional car. 5G infrastructure build-out requires significantly more silver than 4G. The industrial demand for silver is accelerating. But here's the problem. Silver mine production has been essentially flat for the past 5 years. We're not finding new silver deposits at the rate we're consuming existing ones. And unlike gold, which is mostly recycled, silver gets consumed in industrial applications. Once it's used in a solar panel or an electronic circuit board, it's gone. It's not economically viable to recover it. So you have accelerating demand running into constrained supply. Basic economics tells you what happens next. Price has to rise to balance the market. But silver is still trading at $30 per ounce. In inflation-adjusted terms, silver would need to hit $140 per ounce just to match its 1980 high. We're not even close to that yet. I want to tell you about something that happened in 2011 that illustrates silver's explosive potential. In January 2011, silver was trading at $27 per ounce. By April, it had hit $49. That's an 81% gain in 4 months. What drove that move? A combination of investment demand and a short squeeze on the COMEX. Traders who had been betting against silver suddenly had to buy to cover their positions, and that buying pressure pushed prices vertical. We're seeing the setup for a similar situation right now. The short interest in silver futures is elevated. Physical demand is strong. and the price is consolidating after a significant rally. This is exactly the kind of setup that precedes explosive moves. Here's what you need to understand about this weekend specifically. When markets close on Friday, you're going into a period where you can't react to events. If something significant happens over the weekend, a geopolitical event, an economic announcement, a banking crisis, you're locked out. You can't buy. You can't position yourself. You're a spectator. The people who are prepared before the weekend, they're the ones who capture the opportunity. The people who wait to see what happens, they're the ones who end up chasing prices higher and buying at the top. Let me give you a specific historical example. On Sunday, September 14th, 2008, Lehman Brothers announced they were filing for bankruptcy. Markets were closed. When they opened on Monday morning, gold gapped up $70 per ounce. If you weren't already positioned in gold, you missed that move. You couldn't get in at the pre-crisis price. You had to pay the new, higher price that reflected the crisis. The same thing happened in March 2020 when COVID lockdowns were announced. Gold dropped initially as everything sold off, but within 2 weeks, it was making new highs. The people who understood that a global pandemic would lead to massive money printing, they bought during that brief dip. The people who panicked and sold, they missed the entire rally from $1,500 to $2,000. Right now, we're in a similar moment. The signs are all there if you know what to look for. Central banks are buying. Physical demand is strong. The paper market is showing signs of stress. Geopolitical tensions are elevated. The dollar's reserve status is being challenged. Inflation is running hot despite what the official numbers say. And here's the thing, you don't need to predict exactly what's going to happen or when. You just need to understand the direction things are moving and position yourself accordingly. Gold and silver have been money for 5,000 years. They've survived the collapse of every fiat currency ever created. They're not going away. The Roman denarius was debased from pure silver to less than 5% silver over a period of 200 years. The result? The Roman Empire collapsed. The German Reichsmark was printed into oblivion in the 1920s, leading to hyperinflation where people needed wheelbarrows full of cash to buy bread. The Zimbabwean dollar became worthless in 2008 after years of excessive printing. The Venezuelan bolivar has lost 99.9% of its value in the past decade. Every single time a government has tried to print its way to prosperity, it has ended in currency collapse. And every single time, gold and silver have preserved wealth through the crisis. This time is not different. The scale might be larger, the mechanisms might be more complex, but the fundamental dynamics are the same. The US dollar has lost 98% of its purchasing power since the Federal Reserve was created in 1913. That's not a conspiracy theory, that's official government data. A dollar in 1913 could buy what $28 buys today, and the rate of devaluation is accelerating. The dollar has lost more purchasing power in the past 20 years than it did in the previous 80 years. Where does that purchasing power go? It doesn't just disappear. It transfers to hard assets. Real estate, commodities, and especially precious metals. Gold and silver are the ultimate stores of value because they can't be printed, they can't be debased, and they're recognized globally as money. Now, I want to address something that I hear all the time. People say, but gold doesn't pay interest. It doesn't generate cash flow. Why would I own it? Here's the answer. Gold is insurance. You don't buy insurance expecting it to generate income. You buy it to protect against catastrophic loss. If you have $500,000 in retirement savings and the dollar loses 50% of its purchasing power, you effectively have $250,000. That's a $250,000 loss. If you had allocated even 20% of that portfolio to gold, and gold doubled as the dollar halved, you'd have protected a significant portion of your wealth. This isn't about getting rich quick. This is about not getting poor slowly. It's about preserving the purchasing power of your savings so that when you need that money in retirement, it can still buy what you need it to buy. And here's something that should really concern you. The average American has about $200,000 saved for retirement. Social Security is projected to be insolvent by 2033. That's less than 9 years away. When that happens, benefits will be cut by about 25%. So if you're counting on Social Security to supplement your retirement income, you need to plan for significantly less than you're expecting. Meanwhile, the cost of healthcare is rising at 6% per year. The cost of housing is rising at 8% per year in many markets. Food costs are up 25% over the past 3 years. Your retirement savings need to not just keep pace with these increases, they need to outpace them, or you're going backwards. Traditional investments like bonds are paying 4 to 5% right now, but inflation is running at 3 to 8% depending on how you measure it. You're barely breaking even, and that's before taxes. After taxes, you're losing purchasing power. Stocks have been on a historic run, but valuations are stretched. The S&P 500 is trading at a price-to-earnings ratio of 24, well above the historical average of 16. That suggests limited upside and significant downside risk. Gold and silver offer a different proposition. They're not about generating returns in dollar terms. They're about maintaining purchasing power regardless of what happens to the dollar. And right now, with all the risks we're facing, that's exactly what you need. This weekend, while markets are closed, I want you to think about your financial situation. Think about how much of your wealth is denominated in dollars or dollar-based assets. Think about what happens to that wealth if the dollar continues to lose purchasing power at an accelerating rate. Think about whether you're truly prepared for the economic environment we're heading into. The time to prepare is before the crisis hits, not after. The time to position yourself is when you can still get physical metal at reasonable premiums, not when everyone's panicking and premiums are 50 to 100% above spot. The time to act is now this weekend, before markets open on Monday and potentially gap higher on whatever news develops. I'm not saying you need to put everything into gold and silver. I'm saying you need to have a meaningful allocation that can protect you if things go wrong. 10%? 20%? That depends on your individual situation, your risk tolerance, your time horizon. But 0%? That's not a strategy. That's hope. And hope is not a plan. The wealthy understand this. They've been accumulating gold and silver for years. The central banks understand this. They've been buying at record pace. The question is, do you understand it? And more importantly, are you going to act on it? This weekend represents a moment of decision. You can continue on the path you're on, hoping that everything works out, that the dollar maintains its value, that inflation comes down, that the government gets its fiscal house in order. Or you can take action to protect yourself regardless of what happens. The choice is yours. But the clock is ticking. Markets close in a matter of hours. And when they reopen, the opportunity you have right now might be gone. The price might be higher. The premiums might be higher. The availability might be more constrained. Don't let this moment pass you by. The weekend is here. The question is, are you prepared?